options pricing. So we're mainly going to be focused on the Greeks. So if you've maybe heard that term, but not completely familiar with what all those things mean, that's what we're going to be covering today. Next week, we'll talk about volatility. And, uh, you know, I almost wish we could flip these around a little bit because volatility has definitely been the theme for the last couple of days of the market being open. And we're seeing it today to the upside, but certainly something that we really hadn't seen much of for really the last I want to say year and a half. I mean, there's been bouts of it, but certainly nothing as severe as what we've seen over the last couple of sessions. But we'll do a deep dive on that. And I think that's maybe, if I had to pick one, they're all important, but if I had to pick a week, that's the singular most important week of the class because that's really the part that's overlooked by a lot of options traders. They don't understand how volatility is affecting options pricing. And for that reason, and we're going to talk about it to a certain extent today. But if you don't understand how volatility is priced in to options, it's really hard to have a good grasp and understanding of what you're even trying to accomplish, right? Maybe you have thoughts about where a stock could go, and maybe that comes true. Maybe that's exactly what ends up happening. But if you're not understanding how volatility is priced in, you still could be not profitable on said trade just because what was priced in was expected by the market. So sellers actually end up winning those trades. In week three, we'll talk about one leg versus two. So in the beginner's course, we mainly focused on those four main option strategies: buying calls and puts, selling calls and puts, and then doing some things with maybe shares involved. But in week three, we'll actually jump in to those multi-leg strategies. Mainly, we'll focus on spreads. We can talk about other things if they come up. We don't like to make it too complicated because we do one-off classes on a lot of the different multi-leg strategies, butterflies, condors, things of that nature. And then in week four, we'll talk about generating options trading ideas because that's ultimately at the end of the day, once you have all the fundamentals down, all the mechanics of how options work, you have to be able to go out there and scan through the market and sort what's going on and generate ideas. So that is kind of the agenda for the next 4 weeks. Let me just go over to fidelity.com really briefly here because I do want to take everybody through what we need to be aware of in terms of the class and where we can get some of the materials that we're going to be covering here in the next 4 weeks. So if you're on the main Fidelity page here, what you can do is, and if you want to just skip this page without having to click through all the things I'm about to click through, you can just actually type in fidelity.com/classroom. And that'll get you to the page that I'm about to show you. But if you're already on the page, you can go to news and research and then down to learn. That'll take you to our main learning center. And once you're there, what will actually happen here, this is going to load. Computer's going a little bit slow this afternoon. And what you'll see on the left-hand side is a couple of different things, but you'll see events is the main thing that we're looking for. When you click on events, it'll take you to a pop-up window here. And on that pop-up window, you'll see trading strategy desk coaching. So those are those one-off classes that I'm talking about. So, if you're attending this and you want to already get a head start on maybe some of those specific ideas, you can see them on the trading strategy desk coaching page. But for the 4 weeks that we're dealing with here, we're actually going to go down to classes. And once we go to classes, what will happen is it'll take you to a page. It'll have a list of all four, or actually now we have five, I believe, classes. And we're just looking for that one that is options intermediate. And when you click on the options intermediate class, learn more and register, which I'm assuming most, if not all of you have already done, because that's how you wound up in the classroom today. You'll see a couple things that you need to know. So, we often get asked, where do we get the slides? And you can get them right here on this page. So if you just go to, and I know this is for July, it's going to be the same though. If you go to download slides, you can click on that. That'll give you the PDF. It'll have all of the decks that we're working with here for the next couple of weeks. And then in addition to that, you'll notice that if you go up to the week 1, 2, 3, and 4, those are actually hyperlinks. And if you click on them, we will review a homework. Not today, because obviously there was no class before this one, but going forward, starting next week, There will be a homework. It's, not mandatory by any stretch of the imagination, but if you just want a little self-assessment, a little knowledge check, you can complete that and we'll cover it at the beginning of the next 3 weeks. All right. With that being said, Albert, I know we have a lot to cover in the next 4 weeks, and that's certainly not something that is going to change today. So let's hop right into it. If you don't mind just taking us through maybe the first couple slides here to get us kicked off, and then I'll jump back in.
Yeah, absolutely, Matt. And I like this class. I agree with you about the volatility, but the way I like to learn things is really breaking it down to its the most simple element you can to really understand what's going on. I think the understanding how options are priced is going to do wonders for helping people understand exactly what to expect, at least understanding why an option is priced the way it is. So that's what we're going to talk about today. We're going to talk about option price components. We'll talk about factors that affect price, and of course, we can talk about planning our trade after that. So let's go ahead and start with option price components. And again, I think this is a great way to kind of really break things down to the simplest element, understand what is involved in pricing of options. So, and the biggest thing, the difference here is that when we're talking about trading stocks, it's pretty straightforward, right? It's up or down, and that's really all we're concerned about. Now we start dealing with options, we've got a variety of other factors that we need to consider. And as you can see, there's 6 of them right here. And I'll even go a step further and say we can ignore interest rate for the most part. It really is not a tradable Greek for the most part, unless you're doing only long-term, long-dated options, and even then it's negligible. And then of course we can ignore dividends for now because not every stock pays a dividend. Let's just kind of think about this in the simplest form. It's stock price, strike price, time expiration, volatility. And so as we combine these 4 elements together, this helps us to really come to understanding of what that op price is. Now, of course, you take all these different things, we throw them into an option pricing model, and that's how we get our theoretical price. In other words, we would throw, the underlying price, the strike price we're looking at, the time expiration, the current volatility levels, and we would get throw that into our model, and that's where we get that theoretical price. Um, if we take a look at some of the things that are involved with regards to valuations, we can think about it from this standpoint, right? What are the factors that affect supply and demand for options? Because really, when we're talking about volatility, this is really what we're talking about. And again, as Matt said, we'll get into volatility in depth next week. But in the meantime, we should have at least a cursory understanding of it. So let's think about it from a supply and demand standpoint. We've got stock owners get nervous, they buy, and so therefore we've got a higher expected move in the security. From that, we buy options for protection or even for speculation, right? Which that high demand is manifested in the option contracts. And of course, the buying pressure raises that IV level. So we've got a higher IV level. So in other words, the implied volatility is driven by supply and demand. That's what we're really talking about. It's the simplest way we can think of it. If we're talking about people coming into the market and buying particular options for a particular reason, expect that the implied volatility of those options are going to go up. So that may, in most scenarios, we're talking about individual stocks. We're typically talking about buying puts, right? We're talking about buying the panic side of the market. In other words, we don't necessarily, panic on the upside. Although there are examples we can talk about with regards to, FOMO on Nvidia, for example. But typically, in general, we're talking about panicking to the downside. We're talking about buying puts, and that demand for those puts raises those IV levels, which is why typically, again, I'm using typically here, when you look at the volatility levels of puts versus calls, you will most of the time see puts are higher than calls. So keep that in mind. Again, the implied volatility really can be used as a measure of an option's relative value, right? So supply and demand, just as I was saying. But the bottom line is this: we get a situation where options are being bought. The result is more expensive premiums. So again, thinking back to what I was saying before, if nothing has changed with that particular option, right? Nothing has changed with the underlying price. Nothing has changed with the strike price. It's still the same day, so nothing's changed days of expiration. There's really only one thing that can explain the change in premiums. That, of course, would be higher implied volatility levels. From the opposite side, again, we can look at maybe rising market improves outlook. So therefore, there's lower expected move in the security. So you may sell income options for income, right? Think covered calls or things of that nature, or maybe even cash covered puts, or even just selling positions you already had on. That lowers the demand for options. That selling pressure lowers those implied volatility levels, so therefore we get those lower IV levels. So result is less expensive premiums. When do we see this type of scenario play out? When is the most common time to see these play out? Think about around earnings, right? And Matt was kind of alluding to this previously when he talked about volatility. Think about around earnings and the lead up into earnings. Typically, what you see is volatility levels pick up ahead of earnings. Why is that? Most likely, people are either buying protection against the case of bad earnings, or they're speculating because they think they're going to have good earnings. And what do you typically see? Well, you typically see implied volatilities move up on those options that capture that earnings event, right? If you were to compare an option chain and look at one option versus another, one that expires after the earnings, one that expires before, you're probably going to see higher levels of implied volatility. What typically happens after the earnings, right? It's kind of a buy the rumor, sell the fact. Implied volatility levels dip. More than one time on the service side of things, I've had to call when someone said, "Hey, listen, I thought these earnings were going to be great. I bought a call. I was right, but my call is worth less. What happened?" Well, that's exactly what happened. It's implied volatility, right? You got involved into a situation, the market was anticipating certain things. The volatility levels moved up in anticipation of that. We got the event, and now there's probably selling, either taking profits or covering situations that you may have been short and not want to be short, whatever it may be. Those levels are now driving down the implied volatility levels. So keep that in mind going forward. Supply and demand are typically one of the things that drive those implied volatilities. That's, of course, a simplistic explanation. We'll get into it more next week, but that is a really simple way of thinking about implied volatility. Now, when we review the components here, and this is why I kind of wanted to break it down into those four elements, because the premium is essentially made up of the intrinsic value and the extrinsic value. All right. Well, how do we determine intrinsic value? Intrinsic value is just simply how much is it in the money. And the way do we determine that is by the underlying value and the strike price. If we have an option, a 100 strike option call, and the stock is trading at 105, well, that call is $5 in the money. It's $5 of intrinsic value. So very cut and dry. The extrinsic is the amount of that premium that's explained by anything other than intrinsic value, right? So in other words, this is those other two components. This is the timed expiration and the implied volatility levels. So going back to that example of a call, a 100 call when the stock is trading 105, if the price of that option is $7.50, well, we now know what makes up that premium, right? We know that there's $5 of intrinsic value and there's $2.50 of extrinsic value. That's that timed expiration, that volatility. Why is that important? Well, it's important because, again, options are a decaying asset, right? It's going to expire at some point in the future. And between now and that point, if nothing changes, if we stay right where we're at, it's only going to have intrinsic value. That means that extrinsic value has to come out of that option between now and expiration. So understanding what drives that extrinsic value is going to be very important. It could certainly be the determination as to whether or not an option trade is profitable. So those are the kind of the very basic elements of option premium. Matt, I'm sure you've got some things to add here. What else do you want to add with regards to these premiums?
Yeah, I mean, you can kind of see what occurs when we have a big price drop, or some would call this a price shock that we've seen from the last couple of sessions, and you can see that specifically that demand and supply function at work and how it affects volatility, and you can do that just simply by using the VIX as a proxy. But what I'll do here just for a second, just to kind of highlight the point, because Kelly was asking a question about why implied volatility for puts is higher than calls. And that's generally speaking going to be true. It's not always going to be the case. Sometimes it can go in the opposite direction, but especially when we're looking at the broad indices, it's very rare to see calls have higher implied volatility than puts. It can happen, but it's quite rare, especially as we start going out of the money. One of the easiest ways to see this probably is just by looking at the S&P 500, and then we'll look at implied volatility 30, which is effectively a VIX-like calculation. And what they're trying to do here is they're trying to use option pricing to create a synthetic 30-day option. And that's just a really fancy way of saying we're standardizing this so we can look at an IV30 on SPX. We could look at an IV30 on QQQ. We could look at it on NVIDIA, Meta, whatever it is that we're trying to look at, and we can compare one to another on a notional basis to really determine which one is more volatile based on the way options are being priced. And options are being priced that way based on usually a response to historic volatility and what the stock has been capable of doing. But what you'll notice here is we zoom in, and let me make this a little bigger so everybody can see. And we already started to see a little bit of volatility uptick, even as we went higher into the middle of July. And then it really started to take off once we had that initial drop. When you see it go from a single digit handle here all the way up to 13, which, think about that in percentage terms, that's quite a large move when we're thinking about it in percentage, even though it's only going from 9 to 13 on a notional basis. We drop again, we go a little bit higher, and we start to rally. And then when we had that big drop on Friday, starts to take off again. And then yesterday, of course, and this is just based on the closing value. It's not even as high as it got intraday. And this is IV, not VIX. VIX uses more out of the money stuff, whereas IV is concentrated to at the money stuff. So IV is always going to be lower than the VIX reading. But basically the point is, when we started to really cascade down, you saw the ability for implied volatility to take off. And that's because there was a rush out there to buy put options. And you're buying put options typically because you're trying to protect a portfolio. And yes, to answer the question specifically, Kelly, the reason why puts generally are more in demand, or especially when things are going down, why people rush out there to buy puts rather than when the market's going up. Why don't they buy calls? And sometimes they do. That's a thing that can occur. Arguably, we just saw that on Russell as it was going breaking out to the upside. We're kind of having a melt up there for a couple of days. But on the put side, especially for the indices, the reason why is because if you think about what most people are in terms of, are they long, are they short, meaning do they want the market to go up or down? They want it to go up. That's what the vast majority of market participants are ultimately seeking. And when that starts to go the other direction, then there's a rush for protection because people don't want to lose money. Whereas on the call side, even if it's going up aggressively, yes, sometimes speculators will come in. That's a lot more common on individual names, but you don't see that mad rush to go out there and buy call options because, well, everybody's feeling pretty fine, right? Their account portfolio sizes are going up. Whereas when we're seeing a crash or a little bit of a meltdown like we've seen the last couple of days, there is a panic and there is a rush that sometimes can set in to buy those options. So just wanted to explain that from a VIX or an IV30 perspective. They're similar, but we really saw a great example of that here in the last couple of days. So just wanted to show it before we hop back over into what's going on with factors that affect options pricing.
Let me tack on one more thing,
Yeah.
one more thought here, Matt, because I think it's important to kind of understand this point. It's really, Kelly, it's the direction of panic, right? So in other words, typically when we're looking at S&P 500 or a stock, it's puts. But if you were to look at, say, maybe a gold ETF like GLD, for example, or even a treasury ETF, there's a good chance the calls are probably higher because that's the direction of panic, right? In other words, if we're looking for a flight to quality or safety, you would typically think of buying protection for the downside on stocks. You typically think of buying upside for gold and treasuries and things like that. So just think of it as the direction of panic. That's really the way I like to think of it.
Yeah, and that probably is a better description. It's the fear of the velocity of the move. It doesn't mean that the market necessarily even thinks that we're headed down. I mean, it feels like that usually, but volatility isn't in and of itself directional in nature. It's talking about the size of the move rather than the direction of the move. It just so happens that, as Albert was explaining, people get a lot more scared of the market crashing than they do of it melting up. And I've already explained the reason for that is because people are long usually in their portfolio and they want it to go up. If it's doing it at a fast rate, it's nothing to be scared of. It's something to get excited about. Well, at least in the short run. Sometimes when that happens, it leads to what we've seen the last couple of days. All right, so going to factors that affect price. So there's three main ones that we're focusing on. There's a couple other that come into play specifically in regards to things like interest rates, but the main three that we're talking about is stock price, time to expiration, and volatility. The first one is probably the most obvious. I think that's the one that, as an option trader, even if you're brand new, you're thinking about it from the perspective of, okay, I'm buying this. As long as you understand the basic mechanic of what an option is, it gives you the right to buy or sell a stock or the obligation to do one of those two things. You understand that the directional component is a pretty obvious piece that you need to get correct. However, the next two probably less understood, the third one more so than the second. That second one is the time to expiration. And what that's representing for us is basically, unlike a stock, if I buy it or even if I short a stock, as long as the stock doesn't go out of business, I can always just continue to hold it. And even if I'm wrong in the short run, as long as it eventually comes back and it goes above where I purchase the stock, I end up making money. Now, if you actually made money based on inflation and real gains, that's a different story. But just if we keep the example simple, if I bought a stock for $10, it goes down to 5 for 2 years, and then in the third year it goes up to 15, guess what? It still made 50% on what I paid. With an option, that's not going to be the case. And the reason why is because they expire. There's a date at which you have to be right in. If it's not going to happen during that point, you could potentially re-up the trade and add more capital, or extend duration if you're the seller, then you're actually receiving more capital. But at the end of the day, you're extending the trade and it's a variation of what you originally did, right? Even if it's the exact same strike, you change the date and you're adding more capital. So basically you're doing a new trade at the end of the day. So very important to understand that. And typically there's going to be different responses. The simplest way to think about it is the longer you go out in time, the more an option is going to cost, or the more you could sell it for. If you're dealing with a shorter time frame, it's going to be cheaper. And if you just think about the logic behind that, it's pretty simple, right? If you think something's going to happen, would you rather have a week for it to happen, or would you rather have a month? And then if you were given the choice between a month and 9 months, which one would you rather have? And most people would say, well, if I'm convicted of something is going to occur, then I definitely much rather have more time. And for that obvious reason, the seller of the option is going to say, okay, I'll give you more time, but you got to pay me more money because a lot more can happen. And the other mathematical thing to be thinking about here is the probability distribution of different price levels. So if we're dealing with a stock, I mean, we'll just use NVIDIA. It was on my screen there for a second. It's around $100, slightly higher. I think it's around 106. If you had to put a band around that price on the high side and the low side, but we're going till Friday, where would you put those price bands? Probably a couple dollars either direction, right? And we could see exactly how much the market is currently placing around that based on the straddle price. But let's just say, it's $4 on either side, so maybe eight overall. So we think it could potentially get up to something like 114. Maybe we think it could go as low as 92 or something like that. But if we were to go out and say, okay, well, forget about this week. What if we were to go to the end of the year? What would my price bands look like? Well, they'd be a lot wider because I have a lot more time for that thing to go in one direction or the other. So we need to adjust our possibilities of price being at a much more distant place than we are currently right now. And that's the basic function of why options get more expensive as you go out in time. And then finally, we have volatility. Again, we're going to talk about this some today. Well, we'll spend a whole week on it next week. Well, a whole 1 hour session in the week. And basically, this is that demand supply function that Albert was talking about. When volatility is going up, and usually it's in response to the market going up or going down. In the case of, most securities, it's when things are crashing, that's when volatility really starts to set in for a couple reasons. Well, first of all, if I'm trying to buy the put, somebody has to be selling me that put. If I'm selling the put, I'm taking on the obligation to buy shares from you at whatever strike price we agreed upon. Well, if the thing's been in free fall for the last couple of days, maybe I'm still willing to sell the put, but I'm going to demand a lot more premium because I think that it could continue to go down. And if it goes down, I want to be rewarded for taking on that risk. Now, if I'm selling the put, hopefully my opinion is that I think it's going to stabilize. I think it's going to go back up, something to that extent. But because the possibility exists due to the recent price action and how the market is currently pricing those options, I'm demanding more premium upfront for selling you that put. And same thing with calls, right? And part of the reason that exists is because of this idea of put call parity, which is basically that we can make a long stock position with just options. We can make a long call by owning the stock and buying a put. And if those things ever get too out of whack, if only one side of the option chain were to move and not respond to volatility, then there's ways to basically arbitrage the situations and create synthetic options, take the opposite side, and then capture the margin. And here's the reality, Albert, I'm sure back in the 80s or 70s, I forget when you worked on the floor, but back in that time, there were probably opportunities and localized markets that would pop up here and there and here and again, where you could go out and maybe see a discrepancy and you could make a trade and create that arbitrage. But even those, they didn't last for very long because people knew what they were doing. And if that ever, popped up, somebody would start putting on a trade until the price is readjusted. Today, it's even more efficient with the advent of trading algorithms and things of that nature that are scanning all the different marketplaces and looking for those discrepancies. And if they do get out of line, they tend to get corrected very, very quickly. All right, let's talk about the underlying stock's price because this is the one that again that is probably the most understood by most people, but there's still some nuance to it that maybe some of you don't know, and it's something that we need to think about. So the first and foremost one is that if the stock itself is higher priced, the options are going to be higher priced. And why is that? Well, if we think about what a 1% move is on $1,000 stock, it's not a whole lot, right? It's barely anything. Or I'm excuse me, I'm in the exact opposite. It's a lot more than if we're thinking about a $5 stock. So if we're thinking about a $5 stock, a 1% move is 5 cents, whereas on a $1,000 stock, a 1% move is what? It's $10. So if something can move $10 and it still only be 1%, then that has to be reflected in the options price. So if you just go there and look at, if you want an example of this, and maybe I'll just show one really, really quickly. So if we go out there and, some of my common ones, I used to use Amazon and Nvidia, but those have all done splits now. I think this is still somewhat, yeah, this is a high price stock. So this is Booking. It's a almost $3,500 stock. If you go and look in at the money option here for Booking, we'll look at these columns that are blue on the left-hand side. So this 3460, this is an option that expires in 10 days. So we're talking about something that, doesn't have a whole lot of time. If I wanted to buy this option, it would cost me $5,900 to $7,150. So thousands of dollars to buy this option. Whereas if we went and looked at something, and this one's not even that low, but if we looked at something that's double digits, and let's go to the at the money options, $27, notice that the option price here is going to be $100 or $102. So very clear to understand a $1 move in percentage terms on 27 is going to be maybe not even quite equivalent, because if we go back to Booking, it was 56% implied volatility. And I'm not sure because I don't actually look at Booking that often. Yeah, it's only 28% here. So if we did the percentages, we'd probably find that 1% is quite a larger move for Palantir than it is for Booking.com. So that's the first thing that we need to understand about the underlying stock price. Higher price stocks, ETFs, tend to have higher prices. And then the second thing about that is, well, how can we actually measure what my option should do based on a $1 increase to the underlying stock price. And that's our first Greek that we're going to discuss today, which is delta. And this is effectively telling us if the underlying stock or ETF were to move up by $1, how much should my option price go up by? So if we're looking at a long call with a 50 delta, which in a lower interest rate environment, those are going to be the ones that are right there at the money. Well, my option should increase by 50 cents. And if it moved up $10, there's another Greek that we need to consider here. But if we just thought about it approximately based on delta, well, then we know that it should be going up by what? About $5, because we have a 50-cent move on one. We have 10 times that move, just slide the decimal over one spot, and my option should go up by that amount. Now, it's actually going to be more than that, because as this underlying stock moves up, the delta will actually shift with that. In the case of a long call, it will get more in the money and the delta starts to get larger. So it should be a little bit more than that $5 move, but we'll get to that in just a moment. Now, there's a couple of other things that we can do with delta as kind of a trader's rule of thumb, or just a quick note to keep in our head, which is right over here. So the first thing is, this also tells us the equivalent amount of shares that we're controlling by doing a certain option. So if you wondered yourself, well, what is actually the difference between buying a strike that's out of the money versus at the money versus in the money? What is that equivalent to in terms of my actual exposure? Well, the delta is one way to measure that. If we have a 50 delta, this is telling that we're approximately putting on a 50 share position. Now, that's dynamic. That's at that moment in time, that's a snapshot. As the underlying price moves, as time moves, as volatility changes, all of that is going to change dynamically. But at that moment in time, it's like putting on 50 shares. Well, if we go out of the money and bought a call that has a strike price that's much higher than the current market price, our delta is going to get lower, and therefore we're taking on less of a position, but we're also not spending as much money, which is why we're gaining leverage. Because at the end of its life, if it does go in the money, all options end up controlling 100 shares. If we reverse the other direction, we're thinking about a delta of, let's say, 70 or 80. Why don't we use 80? Well, that's like controlling 80 shares of the underlying stock. And then the other thing that we can use delta for is our assumption or our approximation for our chance of being in the money by expiration. And I want to make it very clear that when we say in the money, we don't mean making a profit. Those are two different things. Just because your contract at expiration is in the money doesn't mean you made a profit. It needs to be in the money by the amount that you initially paid for the option. If it's not, then you're actually going to lose money, even though you didn't lose it all, right? It's some difference between losing the maximum and actually breaking even on the trade. So that's delta in a nutshell. And then I'll cover one more here, Albert, and then I'll turn it over to you for some thoughts and to take us through the next couple. The next one to think about is time decay. Now, this is a really important one. And this graph over here is starting to get into the details of maybe the not so obvious. I think most people generally understand the idea that if I'm getting more time, I'm going to have to pay more money to buy that option. Or if I'm selling more time, I should be asking for more money. However, when we think about how does time actually decay out of the option, this is less obvious. So the first thing to know, right, is what we've already said: shorter options, less premium; longer options, more premium. Now, in the same vein, think about what is actually occurring. There's a time value and there's an intrinsic value. All of these Greeks are really the remaining ones are affecting the time value that's remaining on the option. So if we're thinking about theta, and we'll just use and actually, I don't like our screenshot here. So let me just pull a live example again. I'm going to switch this to something that's a little less price, but not quite in the low 20s. So I'll use NVIDIA because it's close to 100. So if we're thinking about a NVIDIA contract here, that's at 106, Well, there's two parts to this. There's the intrinsic value, how much it's worth, because, well, the market is slightly above our strike price. So if we were to exercise this long call, then we could buy the 100 shares and we know we can sell them. And we know that we should be able to sell them for whatever the market is at that time. And whatever the difference is between this market value and our strike, that's our intrinsic value. You'll notice that if we had the 102s, well, there's a lot more intrinsic. However, is the option worth 21 cents or whatever the difference is? The answer is absolutely not, because we still have 10 days. It might be that the stock price is significantly higher at that moment in time. If that were to occur, then we don't want to be selling our option if we're selling calls for 21 cents. So there's the time value. And what you'll notice is as we move to our next Greek, which is theta, we'll see that time value is decaying out at a rate. And right now, on most of these options that I've highlighted, it's around 25 cents a day. However, if we were to use one for the end of the year, we'll notice a couple things here. And I'll just use 5 strikes so we can kind of see them both at the same time. We'll notice that, first of all, there's a lot more time value, even though we're going out 136 days. Notice, however, we get significantly more days on this contract than August. I mean, 10 days versus 136. So this is 13 times more in terms of the time. Is the time value 13 times more than what we have for August? And the answer is absolutely not. It's closer to about 3 times more. So how can that be? And the reason why is because time value is going to decay slower on further out of the money or further expiration options than it is for short-term ones. And the reason why is because at the end of the life of the contract, time value is going to be zero. It only matters what the intrinsic value is left on the contract. So theta's job is to get this number to zero by whatever expiration date that we have. And its job becomes more important as we get closer and closer to expiration, because there's still a decent amount of time value left on these contracts, but there's only 10 days. So what you'll see is this number will actually get bigger and bigger as we get closer and closer to expiration. And I'll highlight that point by going in the middle here to October, and we should see something in between. And we do. Notice how, however, that October, it's about half the amount of time here, but it's still closer to December, because that really doesn't start to massively accelerate until the last 45 to 60 days. And that's kind of what the curve is trying to represent for us here. It's pretty flat at the beginning. Once we get into that 60-day window, it starts to increase. Once we hit that 45 to 30-day window, it's really picking up pace. And then when we get under a month left, so about 20, 21 days, it really starts to take off and accelerates even more as we get into the final week of expiration. Now, it's very important to understand that this is for at the money or near the money contracts. It's actually a lot flatter, however, when we start going out of the money. So if we go out of the money significantly enough, you'll see that the theta decay is going to be a lot closer. And, this is a decent example, even though the strikes are not quite the same. Notice how when we start to go out of the money to the lowest one, the same number of strikes for November versus April, notice that theta here is going to be 2, or almost 2 if we round up. If we go to the lowest one here, it's going to be also about 2. It's closer to what all these are doing. So when we're going out of the money or in the money, for that matter, the time decay is going to be a lot more flat. All right, so that kind of covers the first 2 that we need to discuss. Albert, I'll give you a moment because I see you typing an answer in there. But the important thing to start.
Your option should gain or lose 5 cents for 1 percentage point change in implied volatility, all else being equal. So that's how much that option is going to change when the volatility moves. That's going to give you an idea of, when you set this trade up, what you can expect to happen with regards to volatility. Because certainly when we are buying an option or selling an option for that matter, we understand that volatility is not static, right? It's very dynamic. It's constantly changing. So it's important to understand that when that change does happen, how's that going to affect the actual price of our option? And really, as this says right here, implied volatility is the X factor in option pricing. I fully agree. There are plenty of people that don't understand volatility and what it could mean and what it does to a situation. There are a lot of people that will look at the implied volatility levels on its own accord and try to use that as a gauge going forward. But you have to understand that implied volatility has a range, just like prices have a range, right? And if we're at the low end of the range for implied volatility, if we move back to just even the middle of the range, that could have a really substantial effect on your trade and the value of your option. So always keep that in mind. Keep in mind what what implied volatility means and how that could affect your option pricing. Because again, this is the X factor, and it's really, if you want to really get a good understanding of options and option trading, you should really have a deep understanding of volatility. Which again, we'll get spend a whole hour on it next week, so we won't get bogged down too much here today. Finally, just take a look at this real quick with Vega. As you can see, the Vega on this particular example, 0.0535. So again, theoretically, the option will make $5 a contract with a 1% move up in implied volatility and lose $5 with a 1% move down in implied volatility. So keep that in mind, right? Because this is unlike Delta or unlike other aspects we look at, it doesn't have an interest in direction. This will change depending on your position, right? Obviously, as an option buyer, you'd love to see implied volatility tick up because that's going to help the price, as we talked about, that's going to directly affect the price of your option, and you'd like to see your option price go up, right? If you are an option seller, you would certainly like to see volatility go down, and so therefore your Vega would be working with you at that stage, if depending on your position, of course. So if you're predicting an 8% drop in implied volatility after an earnings announcement, again, going back to that situation, I'm sure we probably all looked at or at least have some experience with seeing. If you're looking for that 8% drop in volatility in earning after earnings, so if we did 8 times the Vega times 100, you're looking at $42.80 a contract. So you're expecting the contract price to go from $2.83 to about $2.40, right? You're subtracting out that money from the actual price, resulting in a loss of 42.80 from the 8% implied volatility drop, with everything else remaining constant. And that really is the key, because how often does everything remain constant, right? There's always some kind of changes. But if we're looking at just this element in a vacuum, that is exactly what you can expect to see from your position. Remember, I said earlier, when we're talking stocks, it's pretty straightforward, right? We're just looking at the underlying price, it's up or down. When we're looking at options, it's three different things we're looking at. It's, of course, that underlying price, that timed expiration, and this right here, volatility. So Vega will help us to understand how that will work for or against us in our positions. So I know I've said a lot about that. Anything you want to add to that before we move on to the last piece here, Matt?
I think the really important part to understand about volatility is how it's affecting the actual price in real time. And I'll show everybody what I showed the options market briefing this morning. So that's a class that we do. It's going to start being every Thursday at 10:30. And we just do an assessment of what's going on in the options markets. And so what I'm going to show everybody right now, I'm looking at SPY, and we're looking at from July 9th of last month. And at the time, the price was 555. So we went to the at the money call, the IV was 9.67. So keep that number in mind, and then keep this spread in mind. It was 455 by 458. So that's at those levels of IV. Everything was relatively calm at that moment in time. Now let's go over to SPY today, and we're going to August 16th, and we're on the Tuesday before expiration. That's the same expiration days left that we were just looking at. And we'll go to the 526. That's the closest at the money. And we'll notice that even if you want to use 527 and go slightly out of the money, notice that the value of these options are now $9.25 versus $8.63. On the last screenshot, it was 450. Why? Well, let's come and look at our volatility number. We were looking at a single digit handle on that at the money call a month ago. Today it's at 24. So significantly higher. not quite 3 times, but almost. So it's pretty significant, right? And you'll see that show up most easily when you just go and compare prices and you think about what could I have got this for when volatility was lower? What would I have to pay for it now? And I know the numbers are slightly different because I did this at 10:30 in the morning, but what we were looking at back in July was in order to break even, you needed the S&P 500 or SPY to go up 0.81% to break even. If you did more than that, you were going to start making profit at expiration. When we were looking at this morning, and the prices were slightly different than where they're at, but they were pretty close. We needed it to go up 1.81% in order to break even, and we had the same amount of days left. So that's the power of implied volatility. As that goes up, more movement is priced in. So you need more movement to actually occur to break even on your trade, much less you need even more movement in order for you to start to see a profit at expiration. We have only a couple minutes left here, so let me hop back into the slides and just finish up with what we're going to think about when we consider, well, what does this matter, right? Why do I need to know these things? So first of all, the Greeks really help you, especially as you start to get more advanced. It's pretty obvious. I don't know if you need a ton of Greek knowledge to understand a single leg option trade. If I'm buying the call, here's where I'm placing my price. Here's where I need it to be at expiration. If it's better than that, I make money. Same thing with the put. I need it to go below this price and I make money, or I need to stay the opposite if I'm selling either of those two contracts. But as you start to incorporate more legs, it helps you understand, well, what actual outlook am I expressing with my option trade? And it can get really complex, especially if your position looks like an option chain and you have 12, 15, 30 different legs in there. It can get really confusing. What do I actually want to even happen? The Greeks can answer that question for you. But it can also help you answer the question of, okay, what is my outlook? What do I specifically think is going to happen? Is this the best trade for me? Or should I do something else? Should I use a different strike? Should I use a different date? What's my entry strategy? What's my exit strategy? Which is very important to think about before placing the trade. What's a realistic way for me to get out if this price hits by this date with this volatility level? That's what the options pricing model, and that's what the point of understanding the Greeks is, because you can have a sensible and a decent approximation. You can't know what volatility is going to be. That's the hardest part of it, because that's based on what future actions buyers and sellers take. There's no way to 100% predict that. You can maybe throw some good guesses in there, but even with volatility, if you at least know the price and the time, you should have a decent estimation of what the value of the option should be. So if this outlook happens, here's where I expect my price. Is that risk reward really good enough for me to place this trade, or do I want something better? If the option or the underlying price movement goes against me, where am I going to manage my risk? What's too much? How will that look if I get to this date at this price? Will I be down 50%? Am I willing to risk that amount of money? That's what these Greeks can help you answer. So there's lots of different reasons. I'm not even going to go over this slide because we covered that in other trading classes, but basically there's 3 steps to it. Outlook on price movement. Am I bullish? To what extent? Am I bearish? To what extent? Or am I neutral? Do I think that it's going to stay within a certain range? And then if that's the case, if I'm bullish, do I have positive delta? If you have a bullish outlook and your deltas are negative, this is not good. It means that whatever you've done is contrary to what you actually think is going to happen. And same if you are bearish and you have positive deltas, you want negative ones. You want to make sure that you're making those adjustments. And then finally, right, the entry and the exit strategies here. And I know I'm going through this fast, but we talked through a lot of this as we went. I just wanted to show you, and the slides are online if you want to review them at your own pace. But just to kind of highlight some of the high points here. Shorter term, you're going to get the sensitivity, or we call it acceleration on this slide. Basically, they're going to be more reactive to whatever price is doing that day. But the time decay is going to be a lot more impactful, meaning you need to be right and you need to be right very quickly. Longer term options, you don't get that, instant gratification of seeing a one bagger, or that's what we call 100% profit in one day. But if you're not right, well, there's always tomorrow and probably the next 30 to 60 or 90 or maybe even further out days for that outlook to be correct, as long as it didn't go too much against you to invalidate whatever reason you initially put on the trade. And then finally, do I even want to be a buyer or seller? This is really the volatility question, I think. If I had to, put uh, one of the terms into this category, it's, well, if I'm a buyer of an option, I'm buying volatility. Basically, what I'm actually saying is the market is pricing in this amount of volatility